Hello and welcome to our video lecture on auditing the purchasing process, an overview. First, let's discuss expense and liability recognition. Keep in mind expenses are outflows of other using up of assets or incurring liabilities that you get from delivering goods and services, or basically just carrying out anything that is around the entity's major operations, their central operations. Liabilities are now future sacrifices of actually economic benefits, usually cash, that arise from the obligations where you're transferring assets to provide those services in the future. So as you can recall from managerial accounting, that we have product costs and period costs. If you recall, product costs are direct materials, direct labor, and manufacturing overhead. We call these types of product costs inventoriable costs because they are actually placed in inventory and then they're only expensed through cost of goods sold. Period costs are everything else pretty much that doesn't relate to the production of the product, which would be selling, general, and admin expenses. And then we have systematic allocations, which is where through the passage of time we are allocating the expense to our records. So the purchasing process starts with a purchase requisition or a PO, and it's usually generated in a department, and then so you get the purchase requisition, you issue the PO, then it gets sent to the vendor, your goods are received, your services are rendered, or basically a liability is recorded. And the last step is you pay the vendor. Some companies choose not to do a purchase requisition, and then they start with the PO, then you go ahead and get the receiving reports and the vendor invoice, and then you pay it. So basically this process of purchasing, receiving, and paying. And remember that part of the purchasing, this is part of the AP process right here. So we have types of transactions and financial statements accounts that are affected with the purchasing process, right? So here we have a purchase transaction where if you're doing it on account, you would purchase inventory or any items that, other various asset and expense items. Then you have cash disbursement transactions where you're mostly paying out cash. You're taking advantage of any discounts for early payment and you're pretty much reducing your accounts payable balance. And also you may make purchases and have returns. And keep in mind that purchase returns and allowances are contra accounts. So this goes through the several documents and records that you have. We talked about the purchase requisition, we talked about the PO, now we talked about the receiving report, then you get the vendor invoice. You may also have a voucher that gets recorded through the purchase journal, and remember accounts payable, you have the subledger. Remember that accounts payable is a controlled account. So you run all of your entries through the subledger, which is usually directly into the vendor account. So that way you can see how much money you owe that vendor. Then you might get vendor statements in which you will reconcile your current records with that of the vendor and ensure that they match. You might pay for all of these purchases through checks or EFT, electronic funds transfer. And then you would have a cash disbursement journal and a check register. So the reason we go through all of these types of documents and records is to help you identify the PBC provided by client list. And the reason we do that is so then you know as an auditor what you have to request and what you need in order to conduct a full audit of purchases. And that concludes our video lecture.